Then, if you have these restricted deposits, you can't use them because they are they warranted credit, for example. Then by this, we call them restricted deposits. And we have demand deposits. We have seen demand deposits in chapter 1. In other chapters, this is in Spanish, depósito a la vista, or cuenta corriente. It means that you can use this deposit, these funds, at every moment without restriction. But this is a la vista. You have a check, then when the bank see the check, at the same time that they see them sack deposits, deposit a la vista, then they must pay. Because a check is in order to pay these funds to someone. Or demand deposits. You are demanding these funds. They must pay these funds immediately, without restriction. Here we can see, yes? I have to do it at the beginning. You have come late. But I can't tell you, it's only because you have a deposit to guarantee a credit. The bank, when you ask for a deposit, for a credit, they ask you for guarantees. One kind of guarantee is a deposit. Then, if this deposit is guarantees a credit, you can't use it. You can't withdraw these funds, but this is restricted. The use is restricted until the deposit is paid.
Es lo único que cuando empiezo con una tarjeta de crédito, pero no tengo cómo justificar, puedo dejar dinero en garantía como un depósito y me dan tarjeta de crédito. Tarjeta de crédito con garantía.
I don't know anything about this figure, but it's possible that the bank could approve a line for you, and this line is backed by deposits of the same amount or for a percentage of this amount.
Ya, por ejemplo, a mí me entregaron así, una asignatura, me dijeron tanto monto, dejas en garantía y te damos la asignatura. Y eso fue lo que hizo.
In the most part of the cases, if you do this, they won't pay you a high interest rate. They pay you the lowest interest rate. How much are they paying to you?
¿Para la línea?
Yes, no, for the line, for your deposits. The interest rate for your deposit. Yes.
La idea anual era más o menos de 8.
It's a high interest rate. It's a surprise for me.
Es que me explicaron de que mi caso era porque mi negocio no es tan estable, no estoy todavía en el conflicto regular, todavía lo estoy formalizando. Pero yo necesitaba para hacer compras, entonces me dijeron pues, que se que dejara con el 8 de anual, que es lo alto, y si iba mi movimiento bueno me lo iban a ir bajando. Pero si no pago el mes, a toque cogen mi depósito.
Interesting. I have not known about this kind of service.
Pero eso depende de la situación de cada banco, ¿no?
Yes. You could find that in the future, many banks could use different alternatives to offer their services. In this case, I have not known this kind of service. I have known a case in which if you want a loan, they disburse this loan, but you must guarantee the same amount in deposits. It's a crazy, but in this case it's a crazy figure. Yes, but in this case, 100%. You want 100,000, that you must deposit 100,000. They will charge you 20%, and you will receive only 5%. It's better to use your funds than to pay this interest rate.
Pero mi garantía no van a intereses, ¿no?
That is what I am asking you.
No, yo el 18% me daba el interés a las compras, a la tarjeta de crédito.
Okay, they charge you. They collect you 8%, but they don't pay you. Okay, it's the traditional figure. They don't pay a big interest if they pay one for your restricted deposit. It's the same figure. In this case, we could see, for example, data from a balance, from a theoretical balance. we can see here in the right side loans. And here we can see that at the end of March we have 580,000 soles in loans. At the end of June, 750,000 soles, and so on. You can see an amount that you have at the end of these three trimesters. And we want to know what is the average, how much we have lent in average during this period. And to estimate the average, we must add all these amounts, and as they are 4 samples, we divided this 2,950,000 divided by 4, and the loan average is 728,750. Okay, this is the loan average. So if we want to know what is the loan average of a company, we only must check a balance sheet, and we can add all the total amount of a determined loan. Then when we have add this, we must divide it in divided by the number of samples, and then we have the loan average. Okay, here you have at the bottom of the page in the left side, you can see how we obtain this result. On the other side, we can do the same with deposits. We can take every kind of deposits that we want to study. In this case, I have to write only deposits. And we can see at the end of every trimester, we can see the amount that they have in deposits. And the amount of deposits has a sum of 2,855,000 soles. And if we divided this amount by the sample is 4, we have an average of 730,750. This as an average. So we can operate in this way. It's something that you must take in account, because I could charge you this kind of problems in the practice or in the final exam. What we have to do is, in formula, this. We have the summatory of all the loans or all of deposits, and this is represented by A, the summatory of A. And we have samples, the number of days included in the period. This is 4 days at the end of March, the end of June, of September, of December, 4 days. So we divided this summatory by the number of days. This is 4. This is a formula what we have done. And A sub I is the average that we are trying to estimate. And this information could be used with another information in order to know something more. For example, we have the same data that we have seen before in loans. The sum is, the summatory is 2,950,000, and the average is 728,750. And now we want to know what was the profitability that we have obtained with this average loans. Then we go to the income statement, and we read there financial income from the beginning of the year to the end of the year. Then we have here a financial this information, and the financial statement show us that we have 280,625. We know that we have obtained this amount in interest because we have had an average loan of 728,750. And what we will do, what you can see in the blue zone, the income that the financial income that we have obtained from the financial statement, we divide it by the loan average. And we know that the interest is 30%. So we know that in average, we have obtained 30% as a percentage of income. This is something that is very important. In average, the financial cost, if you are a client of this financial institution, is 30% in average. But we know that it has a very high standard deviation. That we have an information, because if we do the same with all the financial institutions, we can know which is the cheaper, which is more expensive in average. We can do the same exercise with deposits. We know that they have information, we obtain this information from the financial statements, and we know that which is the average deposits that they have. And they have paid, in this case, $98,381.25. And this income or this cost has been obtained from during the year. And we have for this year the information in the left side. So we can divide 98,000 soles and some more with this average deposit. And it means that we are paying 14%. Take this in account, because I take you again, it could be some it could be that I ask you something like this in the practice. And this is the formula. In the formula we have that we have an interest rate that we are paying for deposits or for loans. This is I sub I. I am paying an interest rate for a period. And when we are paying this amount for a period, this amount has been generated by loans or deposits, and we need to know their average. This is A sub I. So we divided the interest that we are paying or charging by the average of deposits or loans, and we obtain the interest rates, the average interest rates for these loans or for these deposits. This is a formula what we have seen in the previous example. In this other case, we have some other information. We have seen 3 data in the previous example, 4 data in the previous example. Now we are seeing only 3. We have 3 data, 3 samples. And in this case, the symmetry of these samples is 1,995,000. So we have 3 samples or 3 days. We divided this and we obtained 665,000. And we know that during this period, it means that we have this during all this period, okay? This is 6 months, a period of 6 months. So we are looking for the 6 months income statement, and during this period we have obtained 166,250 soles. If we divided this amount by the amount that you can see in the blue zone, it means that the interest rate is 25%. It's the same exercise in this case. We have one period of 3 months, and in this period we have a symmetry of loans, and we obtain again the average. During the same period we have obtained 78,100 soles. We divided this interest rate with the loan average, and it shows us that we have 11%. So these are examples that you must study, examples that you must check. In the most part of the cases before this course, you have to do similar operations in the school, in mathematics, or when you are doing your own operations. So it's the same. and I can ask you about this in order to know if you have the interest, if you can estimate the interest rate or not. But it could be that we are not paying interest for the full year. It can be that we are paying interest for a period that is shorter than 1 year. If it is so, this is a formula. In this case, we have, in the previous case, I sub I divided by A sub I. It means interest divided by the average of loans or deposits. But in this case, we are trying to know. About periods. If we are speaking about 4 months, for example, if we are speaking about 4 months, we are trying to analyze this information. Okay? Suppose interest rates for the first 3 months divided by the average of all the year. Of not all the year, for all the 3 months too. Remember that in the case of income statements, we are speaking about a flow of 3 months. But in the case of loans or deposits, we are speaking about a situation. A situation. How much do we have in loans or in deposits in over 1 date, not in a period, over 1 date. By this, we need to check this information. So, if we have information for the first 3 months of the year, for example, for the first 3 months, then I over I, the interest is only for the 3 months, but the loan or deposits, we could consider that it corresponds for the full year. We can assume this in order to help you to understand this formula. Then, if we multiply this by 360 divided by n, we could obtain an annualized interest rate. What is n? The number of periods that we have. How much periods do we have of 3 months in 1 year? ¿Cuántos años de 3 meses? ¿Cuántos periodos de 3 meses tenemos en un año? 4. Right. So n is 4. If you divided 360 by 4, then you can obtain how much, what is the interest rate, the annual interest rate for this 3 months. If we have, how many periods of 6 months do we have in 1 year? 2. So n should be 2. You must divide 360 by 2, and you would obtain the annual interest rate. And how many periods of 1 month do we have in 1 year? 12. Okay, it's very easy. You only need to replace n by the number of periods of the year. And you only need to estimate the interest rates that you will obtain from the financial statements or the average of loans or deposits. We have other assets in the balance sheet. And these are the banker's acceptance. A banker's acceptance is an exchange letter. In this case, the bank has accept to pay a letter. It could be because they have bought something, and when they have bought, they don't want to pay immediately, they want to pay in the future, they defer the payment, and they accept a letter. This is a bank's acceptance. And when they have this letter, when the supplier has this letter, they can discount or they can sell in a factoring operation this bank's acceptance, and everyone can obtain it. It's a very low risk, and many institutions use it. Right now, bankers' acceptances are not just in our country, but nearly 30 years ago, as we have not much liquidity in our markets, banks obtain liquidity with exchange letters that they accept. So this is the banker's acceptances. We have investment subsidiaries. Financial institutions have stock market agencies. They have other kind of entities like financieras. They don't have cajas rurales, but they have pymes and so on. So it means that they have investment in subsidiaries or in warehouses, general warehouses. In these general warehouses, when you have guarantees, they maintain the guarantee in these general warehouses. So they could have many kinds of entities that they want to control. And when it happens, you will see the information about these investments in this account, investment in subsidiaries. Equipment and office furniture are similar. You can see, for example, in the case of Banco de Crédito or Banco Continental or Scotiabank or Interbank, you can see big buildings. But these buildings don't have a big value over the total assets. We can say that it's merely, for example, the less than the 5% of their total assets. Here you can see, for example, activos fijos netos de depreciación. The value of this fixed asset is 2,622,000, and we have seen in previous picture that their loans have a summatory of 90 millions. So it means 2.5%, nearly 2.5%. So you can see that buildings are something that you can say how much money do they have. But if you see their loans, then you can change your words. Buildings is not something important in the assets that financial institutions are managing. And you can see other assets, and in this case, represent 4,700,000. When we are seeing liabilities, we can see different kinds of liabilities. Demand deposits, we have to speak about them, or SAC deposits is the other name. You as financial institution, you must pay these accounts to their owners when you SAC a check or when they present a check and they demand the payment. It's the most important account in the case of banks. Only banks have demand deposits or have SAC deposits. Only banks. The other financial institutions don't have this kind of account. Saving accounts and fixed terms accounts are something that every financial institution has. In the case of saving accounts, you can deposit funds and you can withdraw them when you wish. But the law said that when you deposit an amount in a saving account, you can withdraw any amount after they have been in the account 30 days. And if we are speaking about fixed terms, it means that we could deposit our funds in a financial institution and they will receive these funds for a term or time that we have agreed, 30 days, multiple for 30 days in one part of the cases. But if you want to withdraw your funds, the law said that you can't, but financial institutions allow you to withdraw your funds. But they will pay you a lower interest rate if you withdraw your funds before the term is completed, or perhaps they won't pay you any kind of interest. Here you can see information about financial institutions. And here you can see that they have 99 millions in deposits. And the fixed deposits represent 46 millions, nearly the 46% of the total. And if you see this, the fixed deposits, they are divided in four categories, and the most important is what we call fixed deposits too. Okay. After this, we can see SAC deposits or demand deposits, 27 millions, and saving accounts. If you add all these accounts, you can see that these three kinds of accounts represent nearly the 100% of all the kind of deposits that they are receiving. And you can see here restricted deposits that we have seen at the beginning of the class, and some other kinds of obligations that financial institutions have with other financial entities. We have here other passives and capital. Capital and reserve have minor over liabilities. It means that we have a lot of liabilities, but capital and reserve are part of this, and their share over this total is very low. The law said that they can represent more than 10.5% of total assets. It means that over total liabilities, they can represent more than the same amount. The equity ratio is a ratio that you can see here. You can obtain this ratio by dividing capital and reserve. Capital and reserve, in the case of financial institutions, means patrimonio neto. Okay? But we call them in Spanish capital y reservas, or in English capital and reserve. But in other enterprises, this means patrimonio neto or equity. Okay? So you must divide it, capital and reserve over total assets. And this ratio can't be more than 10.5%. Can't be more. It can be less than this ratio, but not more. Okay? Remember this. Here you can see this ratio, and we have three alternatives. Here you need two data to determine the other one. Here you have three variables. If I give you two data, you must estimate the other one. We have here three alternatives of problems that I can present you in the practice. I can give you information about capital and reserve and total assets. You must estimate equity ratio. Or I can give you equity ratio and total assets. You must estimate capital and reserve. Or in the third alternative, I can give you equity ratio or the capital and reserve, and you must estimate total assets. Okay? These are kind of problems that you can see in the practice or in the final exam. But it could be more difficult than you are seeing here. I can present you many accounts, and you must establish which of these accounts belongs to total assets, and which of them belongs to capital and reserve. So you must determine which of these items or these accounts you must include in some item or other, and then after this you must determine which is the answer of this question. Okay? But these are examples that you can see now. We have long-term passives and capitals in the financial statements. This is adeudados y obligaciones financieras. This account represents all the loans that other financial institutions lent to other financial institutions in order that they could lend this money in our country. The World Bank, the Corporación Andina de Fomento, COFIDE, or other foreign financial institutions could lend this amount. In the case of ETPymes can't receive deposits from the public, so the only way by which they can obtain funds to lend to clients in addition to their own capital is by this account. In the case of micro-financial entities, this account don't represent more than 8% or 10% of in average. But if we are speaking about ETPymes, it represents really more. And here you can see in the case of patrimonio or equity, or reserve and capital, you can see that in the most part of the cases, the social capital is the most important concept in this information, and the accumulated results is the other one information that is important. And here we have something that is important about the capital. We can say that bank capital is the same as bank equity. we have seen many weeks ago that we have considered that bank capital is all the financial resources that they could receive from the market or have by their own. But in this case, in this chapter, bank capital must be considered as bank equity. And when we have this equity, this capital, we are speaking about the own capital, we have in this concept what we know as reserve. We need to have reserve. I have showed you that if we have reserve, reserve are some kind of funds that help us to pay unexpected losses. Do you remember? Reserve is to pay unexpected losses. If we don't have reserve, it's like this picture in which you can see a river that is going down from the hills to the downside. So it will drain your funds. It will be drained your equity if you don't have reserve and you have losses. You need reserve to avoid that your equity will disappear. If we don't have reserve, it means that banking capital, it means equity, will absorb losses because we don't have any other thing to absorb these losses. And it means that we could disappear because we don't have another source of funds to support these losses. And it means that this bank is unreserved. It means that it's a very risky bank because they don't have enough reserve to face big problems. But the green picture, we can see we are asking, in which cases do we need reserve? We need reserve if we have market correction. If we are growing and growing and we grow more than we can. If we grow more than our current economic situation. In this case, we have a market correction. And if we have a market correction, our clients don't sell products, they have problems to recover their funds and they don't pay their credits. We have then a problem because we have a market correction. In other cases, we have had, for example, a growth because we have an economic boom, and after the boom has ended, we begin some kind of recession. Then it is an economic downturn. And if we are facing an economic downturn, it means that we could have losses because our clients are not prepared to this downturn. They have expanded their operation, they have invested in factories, in buildings, in inventories, in vehicles, in many things, and these are assets that you won't recover quickly. Then they can't pay, and we can't recover our credits. And by this, we need reserve. And what are consequences of reserve failure if we don't have reserve or if we don't have enough reserve? First consequence, we have freezing dividends payments. We can't pay dividends if we have losses and we don't have reserve to absorb these losses. We can't pay dividends. Or we must write down equity capital. Write down, retirar, eliminar. Okay? We have a capital, and as we are absorbing losses with capital, we have less capital with less social capital. So these are consequences of reserve failure. And all these three concepts that we have seen show us which are the reserve advantages. First, these advantages are related that this reserve avoid insolvency, so we have funds, enough funds to absorb these unexpected losses and help us to avoid bankruptcy. Okay? These three pictures, the two greens and the purple, show us what are the adverse consequences if we don't have reserve. And the red one show us which are the advantages to have a reserve.
Teacher,
Yes,
the bonds and the shares could be considered the reserve.
the down of the what?
The bonds and the shares.
Bond and shares. Okay, can we consider what about bond and shares?
It could be considered called reserve.
No. If you have profits, after you have ended a period, you have profits. You must divide these profits in dividends, and some of these profits will be reinvested in the financial institution. When you reinvest them, the 35% of this reserve must be, of these profits, must be became in reserve, and only the 65% could be capital. So it's the law. But in addition, you can voluntarily have more reserve. But this is voluntary. Every kind of entity could decide to have more reserve, but they are voluntary reserve. If they consider that they need more, if they consider that that they are running more risk than which is considered by the law. On the other side, you can have statutory reserve. In the case of statutory reserve, it means that your creators, your founders, your previous stockholders have considered that it is better to have more reserve. Or finally, in the case of financial institutions, the SBS can consider that if our economy is growing and growing many months, it is a good opportunity to increase reserve in order to have enough reserve to apply when we are in a downturn. So the SBS obliged to all the financial institutions, when they have more than 5 months of growth, of economic growth, if the country have more or 5 months of economic growth, the SBS obliged them to increase reserve. And when we have a downturn, you can use this reserve to absorb losses. These are all the situation. Then you have
Sure.
yes,
What is a bankruptcy? It's a crash.
quiebra, crash. We have capital creditors' rights. It means that if we have a bankruptcy, who can collect first their debt, their creditors. Senior creditors are the first that could recover their funds after the state, after the employees. Okay, senior creditors. Then deposit holders are the second in the line. Third, junior creditors holders. Four, fixed rate securities. If the financial institution has issued bonds or some other kind of fixed interest securities, in this case they could apply, they could recover their funds after the first creditors. And finally, equity holders. Equity holders, if they find that that it remains some kind of capital, then they can recover their funds. Only then, not before. This is the rank of capital creditors' rights. Here we have the tier 1 and tier 2. When we begin this chapter, we have to speak about tier 1 and tier 2. We divided the capital in two categories. We called the first one tier 1 and the second one tier 2. What is tier 1? We call them core capital. What is core capital? Capital that has the highest quality capital. Why it has the highest quality capital? Because if you are a financial institution, you are not obliged to repay them. If you have a problem, you are not obliged to pay them. This is equity capital. You don't have enough funds to pay, you are not obliged to return this capital to your stockholders. Reserve are funds that you retain to absorb losses. So You don't need, you are not obliged to return them to anyone. And retained earnings. You can retain earnings. You can reinvest them, or you can pay them in dividends. That is your decision. Nobody can oblige you to pay. If you consider that you need to retain those funds, you can retain it indefinitely. Okay? So this is tier 1. It's a capital that is permanent, that nobody can take it away from your company. But in the case of tier 2 capital category, it's different. People, owners, could ask for this capital, can withdraw this capital when the conditions have been accomplished, and you must pay it. And we consider tier 2 capital as lower quality capital. This capital don't absorb losses. The first one can absorb them. Tier 2 don't absorb losses. This is the second condition, the second difference between both kinds of capital. It is repayable to their owners. And in this case, we are speaking about preference share issue proceeds. I must pay interest to these people. I can't pay dividends to their common stockholders if I have not previously paid to preferred owners. We have hybrid capital instruments. And what is a hybrid capital instrument? It is a case in which, for example, you lend money to a company. And when you lend money to a company, you have bonds. But when you buy these bonds, you have the probability, the capacity, the option to change these bonds to stocks. And when you change these bonds to stocks, they will offer you exchange rate stocks bonds. But this exchange rate is not known in the moment in which you bought this issue. Okay? And it is hybrid because it begins like bonds, and after a term, 2 years or 3 years, you have the option to change them to stocks. And finally, we have subordinated debt. Subordinated debt is related with bonds that won't recover their funds in the case of bankruptcy after all the others, creditors, employees, governments, hybrid capital owners, or preference share, hybrid capital owners have recovered their funds before. Subordinated debt, owners only will recover their funds before preference stockholders or common stockholders. This is something that you must take in account and remember.